So these are the results for the 6 months ended December 2011. We're going to briefly look at the highlights for the period and a brief introduction, the financial review for the period, look at the operations, acquisitions, disposals, developments and commitments, touch on some prospects. So as Arthur mentioned, we now have a property portfolio valued at over 50 billion on a consolidated basis, confirming our position as the largest listed property company on the JSE. Market capitalization of 31.6 billion at December when the share price was 18.55 rand. I think we've had, and the whole sector's had a good start. I've spoke to a number of the investors here earlier. The sector's had a good run in the first couple of months of January, February this year. Growthpoint's trading at the 20-odd rand level, over 20 rand. Market cap now closer to 34-odd billion. So a good start for the year for the listed property sector. So we own 412 properties directly in South Africa. We've got exposure to 40 properties in Australia via Growthpoint Properties Australia, which we own 61% of at 31 December, and then 50% of the V&A waterfront. The retail portfolio valued at 12.2 billion. The office portfolio valued at 14.3. Industrial portfolio 7.2 billion. Our half share of the V&A waterfront is valued at 4.8 billion. And then Australia has got about 11.7 billion rands worth of properties today. That's 1.43 billion Aussie dollars. And as I mentioned, we own 61% of that. We're a fully integrated, internally managed property company employing 446 staff across the country, 3 head offices, Durban, Cape Town and Sandton. And then obviously across the country in our different properties, at the shopping centres, different office parks, buildings all over. About almost half of the staff reside at the buildings and not at the different head offices. When I say fully integrated, internally managed, what we really mean by that is we perform all aspects of property management, letting and leasing, facilities management, development management. Everything gets done in-house. If you look at the highlights for the period under review, the total return for the 6 months was 10%, which was made up of an income yield of 7.4% and capital growth of 2.6%. That is an annualized number. The distribution for the period was 67.8 cents, which is 6.1% growth on the prior comparable period. And maybe just a comment on that, it was highlighted in the press that we decided as a board for this set of results that we would change perhaps our view on the policy on the capitalization of interest with regards to the bulk at the V&A waterfront. You may recall when we announced that acquisition, we mentioned that the yield on the income producing assets was expected to be over 7% and that there was 1.2 billion rands worth of bulk where we were going to be capitalizing interest on that bulk. Now we have taken a view that we would be more conservative and we would actually be expensing the interest on that bulk for this period and going forward. And that has cost us probably just short of 2% additional growth. Had we stuck with our original policy of capitalizing interest, we could have been probably closer to, or we would have been just short of 8% growth. So the 6% slightly better, I think, than it appears. We invested a further 469 million rand into Growthpoint Properties Australia by following our rights in about July last year. The total cost at December of our investment in Australia is 2 billion, and the market value at 31 December was 2.8 billion. It certainly has been a really good investment for us. A 43.6% return on the 2 billion annualized for the 6 months, giving an income yield of 11.7% and a capital growth of 31.9%. Now that income yield of 11.7, again, we often get questioned about Australia, why Australia, and aren't there better opportunities in South Africa? And I can tell you now that for a number of years we haven't seen anything yielding above 11%, never mind 11.7%. We haven't probably seen anything decent yielding above 9.5% in South Africa. So we believe that it really has been a phenomenal opportunity for us. Our foreign shareholding continues to grow, and it's increased over the last 2 years from 7%, almost doubled now, to 13.7%. The number of units held by our foreign unit holders has doubled, and that's an all-time high. So I think we are starting to also be noticed by some of the international real estate investors, and with a lot of help of a number of the local analysts and brokers who support us. The vacancy factor reduced from 5% to 4%, and I was trying to flip through a number of my older Investment Analyst Society presentations last night to go back to the super cycle of 05, 6, 7, and 8 to see what our vacancy factors were then, and I didn't really find all the data I was looking for, but I suspect that the current level of 4% is even lower than it might have been at in the best of times in the super cycle. We repaid 2 billion rands worth of CMBS in, I think it was August and September last year. We issued a number of additional corporate bonds into the bond market, 2 issues, a 500 million rand issue for a 4.25-year duration at a margin of 145 basis points. And a 260 million 5-year issue at 150 basis points. We certainly see the bond market as being conducive for us as a diversification for our borrowing sources, and across the board, not only in terms of longer-term bonds, but also in terms of short-term commercial paper, we've seen very good demand for Growthpoint's corporate debt. We raised equity of 1.8 billion rand in September last year by issuing 100 million linked units, which has had a pretty positive effect on the balance sheet. We remain included in the JSE Socially Responsible Investment Index, and for the 5th year running we've been rated as the most empowered property company on the JSE. Subsequent to 31 December, Growthpoint Australia made quite a substantial acquisition, and needed to fund that through a combination of a rights offer and taking on some more debt. And we as Growthpoint South Africa underwrote that rights offer and ended up investing a further 1.1 billion rand into Growthpoint Australia, increasing our shareholding marginally from the 61% to 64.5%. We issued a 3-year corporate bond to the value of 750 million, which got priced at 135 basis points over JIBAR. And we rolled one of our commercial paper issues, one of the 3-month issues, which priced at 27 basis points. And again, due to demand, we increased upsized the size of it from 300 million to 400 million. The history of growth in distributions, what one would hopefully expect from a property company, steadily growing income distributions driven by ultimate rental growth, and as mentioned before, the 67.8 representing 6.1% growth. History since 2003 in terms of asset growth, market cap growth, the unit price and net tangible asset value per share. And I think noteworthy towards certainly in the December period, or certainly since December 2010, the gap between the share price and NAV. We're currently trading at about a 25% premium to underlying net asset value. Right, if we get stuck into the numbers, on a consolidated basis, our gross property revenue grew by 26.1% to just short of 2.7 billion. Property expenses grew at a slightly lower rate at 24.8% to 609 million, leaving the net property income line for the 6 months up at 2,072 million. That's 26.5% up. Our other operating expenses was up by 26.2%, 77 million. leaving the net property income after operating expenses up by 26.5%. So you can see a slight improvement in overall margin due to some fairly good cost control across all the portfolios. Finance costs up 42% to 833 million, reflecting in the main the additional borrowings that we took on to fund the V&A waterfront. And just in that regard, you'll notice from the results that this 6-month results includes the V&A waterfront for a full 6-month period, whereas the previous comparable period didn't have the V&A waterfront in at all. Also effectively didn't include any income statement effect for the waterfront. We then had finance income to the value of 74 million. We adjust for the non-controlling interest. These are the minority shareholders in Australia, in the Growthpoint Australia business, their share of the profits, leaving us with profit before debenture interest of 1,153 for the half year. That's 14.8% up, and that is also the cash that we are distributing in terms of our distribution for the period. The 14.8% growth in absolute distributions gets diluted obviously down to the 6.1% per unit as a result of the additional units that we issued during the period. So where did the income really come from? South Africa, net property income was up 10.3% to 1.479 billion. The V&A contributed 134 million. Growthpoint Australia contributed 382 million. It's up 61.9%. Finance costs, if you look at the details, South Africa 643 million, up 42%. Now we haven't allocated specific debt or any equity for that matter to the purchase of the V&A. So you'll see down below the numbers are potentially a little bit difficult to understand. What would have been ideal is if a direct allocation of debt and or equity to the purchase of the V&A were to be done. Growthpoint Australia, interest expense up to 189 million rand, that's 43% up. Finance income, as we said, 74 million, the adjustment for the non-controlling interest, and leaving us with a distribution for the period. So you can see that if you combine South Africa and the V&A, total up 12.4% to 1,040 million, and Growthpoint Australia up 43% to 113. So Growthpoint Australia making up about 2.4% of the 14.8% growth. If you look at the expense or cost to income ratios in South Africa, marginally down at 27.2%. That includes the operating expense ratio at 2.8, as well as the property expense ratio of 24.4. So that is slightly down on the comparable periods. And I think given the environment that we're in and the pressures that we still face with administered costs in the form of electricity increases, rates and taxes, we believe that that is a pretty good result. The V&A on the right-hand side at about 33.3%. Again, these numbers, the total for the prior period, we haven't done a proper allocation yet of what the asset management cost is. So most of the costs, including the costs, head office costs and asset management costs, are in that number, but V&A is still running slightly ahead of the South African business, and from our side potentially an opportunity. Growthpoint Australia, the mix you can see there changing, where the property expense ratio is rising, and the main reason for that is the fact that we have now diversified substantially into office properties, where the cost to income ratio is substantially higher than what it is in the industrial portfolio. Most of those industrial properties that we had were single tenant triple net leases, so the cost income ratio was particularly low. And as we continue to diversify into office properties, you'll find that that cost to income ratio rises to reflect the mix. Pleasing to see though is that the operating expense ratio has come down, and clearly a factor to do with the scale that one can achieve. Once you've got a decent infrastructure, you can take on another couple of billion rands worth of properties at the head office level without adding to the costs. On the balance sheet side, property portfolio 50 billion, 33.6 of that in South Africa, VNA 4.8, Australia 11.7. It's an increase of about 9.8% over the December numbers. The borrowings, just short of 18 billion rands worth of borrowings, just short of 13 billion of that in South Africa, and 5 billion of that in Australia. That's the consolidated number, that's 100% of it. And then linked unit holders interest, or NAV if you want, 27.4 billion, 26.5 in South Africa. We don't reflect anything for the VNA and GARS, Growthpoint Australia at $1 billion. Acquisitions for the period, or the movement in the property portfolio rather. We started the period with 45.7 billion rands worth of property. You can see the bulk of the activity taking place in Australia, 1.7 billion rands worth of acquisitions there. We sold 459 million rands worth of properties, the bulk of that being in South Africa, 416 million of that in South Africa. There's a foreign exchange translation gain of just over $1 billion, 1,175 million. And then we spent across the three assets, South African portfolio, VNA and Growthpoint Australia, a further 769 million rand on developments and capital expenditure. The fair value adjustment amounted to 1,152 million, taking the total portfolio value to just over 50 billion, including properties held for sale. The fair value adjustment represents approximately 2.3% of the investment portfolio, and I guess reflects the dynamics that we experienced during the period, which include reducing vacancies, growing rentals, and I guess a stable interest rate environment where cap rates and discount rates haven't moved too materially. If we look at our borrowings and loan to value ratios as well as NAV, on the South African side, the loan to value ratio is sitting at 33.1%. That's down from the June number at 37.8 and reflecting the impact of the 1.8 billion rand capital raise that we did. And within that, you can also see the interest cover ratio down from the 3.2 before to 2.8. Again, that probably reflecting the lower yielding VNA acquisition, pulling down the interest cover ratio. Growthpoint Australia sitting at just below 50%, coming down from the previous 55%, reflecting a slight uptick in values there. I think we'll get to that on one of the slides. Values there went up about 2% as a result of valuations and the recent capital raises and rights offers that we had in Australia. NAV per unit up to 16 Rand 13 from the 15 Rand 63 at June 11. If we have a quick look at the overall borrowings, at the bottom you see the consolidated numbers. I mentioned just short of 18 billion. 8.3 billion of that is in the form of secured debt in South Africa, 7 billion of bank debt and 1.2 billion of debt with one of the institutions. Unsecured debt, 4.66 billion, 2 billion in the form of bank debt, 1.76 billion rands worth of bonds, and 900 million rands worth of commercial paper. So the total South African debt, 12.9 billion, and then Australia, 5 billion of debt, which is all secured with over the properties in the Australian vehicle with no recourse to South Africa. Interesting to see, I think, as well, that we have been targeting to increase the percentage of unsecured debt in the total mix. So whereas at previously we had approximately 21% of all of our debt in the form of unsecured debt, we now have 36% of all of our debt in the form of unsecured debt. Something which the ratings agency Moody's, that looks over our shoulder all the time, particularly likes. So we did issue the 100 million units. Essentially, I think at the time, and the timing of it was we used that to settle the 2 billion rand worth of CMBS notes. Loan to value ratio has come down nicely in South Africa. Currently, we have 93.1% of all of our interest rate exposure fixed, and the weighted average duration of our fixed profile is 5.6 years. Moody's have not quite finished their December review, but we're currently still on a stable outlook with Moody's, and our ratings are set out there, global and national scale ratings, which is still pretty much pretty solid investment grade ratings. Subsequent to December, we issued the 750 million bond, and the 300 million CP was rolled, as I mentioned before. So if we get into the operations, the portfolio is particularly well diversified. Currently, 24.3% of the portfolio by value is made up by our retail portfolio, 28.5% from office, 14.3% from the industrial portfolio. V&A makes up about 9.6%, and Growthpoint Australia 23.3%. At the bottom of the slide, you can see the net property income contributions, and V&A and Australia already contributing approximately 25% of the total net property income of the group. If we touch on the dynamics in the retail portfolio, the growth in national retail and retail sales exceeded expectations in Q4, the fourth quarter of 2011, but we believe it will weaken slightly into 2012. Turnover growth at Growthpoint's top centres outperformed national retail sales with double-digit growth at Brooklyn, Woodmead and Warmer Park. The overall arrears were impacted negatively by the local authorities' incorrect billings, and we experienced a massive rates back charge at Northgate to the value of 22 million. Our share of that as a 50% shareholder being 11 million. I think across the portfolio, and I'm sure across the industry, we're finding obviously it quite challenging dealing with councils, dealing with issues of rates and taxes, electricity, water, meter reading. Continues to be a problem for us, and I'll talk about that later in the prospects. The vacancy factor in the retail portfolio deteriorated very marginally, and but if you strip out the deliberate vacancies that we have, where we are doing developments at Brooklyn Mall, at Waterfall Mall, Long Beach Mall and River Square in Vereeniging, the actual core vacancy remained at about 2.7%. So on the table on the right-hand side, portfolio vacancy in retail is 3.6. That is, as I mentioned, an increase, but there's nothing untoward there. The vacancies, the increase is almost entirely due to the developments that we're doing. The top 10 centres, the vacancy is 1.7%, and then the balance of the portfolio 5.2%. Total arrears 26.4 million. That's up just short of 10 million from the comparable period, and again almost entirely due to that back charge of the rates at Northgate. Bad debt provision fairly constant, and pleasing, I guess, is an increase in the renewal success rate, where 82.4% of all of our leases that expired in the retail space were renewed, and we achieved a renewal growth rate in rentals of 7.1% in the retail portfolio. Office portfolio, and I think here we seem to be showing slightly different trends and numbers to many of our competitors. We're seeing that the vacancies in all the regions has come down, and that's been achieved through focused letting strategies as well as improved broker relationships. New lets of over just short of 65,000 square meters were undertaken in the 6-month period, reducing that office vacancy to 6.7% from 8.1%. We renewed leases in respect of 86,000 square meters, and that renewal rate also very pleasing to see how that's gone up to 72% from the previous reporting period of 55%. Developments in progress at Grosvenor Corner on Jan Smuts Avenue, Mayfair on the Lake, which is a property on the Lelusha Ridge in Durban, and Menlyn Corner. Those three together will increase the GLA by just short of 20,000 square meters by the end of 2012. Mayfair on the Lake as well as Menlyn I guess, could be considered as speculative developments where we have not got any tenants, but these are very well located properties in highly desirable office nodes. So we expect the remainder of the year to be challenging in the office space. And when the vacancies reach these kinds of levels, not only in the office portfolio, but also in retail and industrial, I suspect it's going to be really challenging to continue to bring them down. But certainly we'd look to achieve that, and if nothing else, then at least maintain them. The only dynamic in the office portfolio that is noteworthy is the fact that on renewals, notwithstanding a 72% success rate on renewals, our renewal growth rate was negative, negative 4.4%, indicating, I think, the difficult office market that is out there, and possibly also our strategy to rather get the space let at rentals that are potentially not quite optimal, but it's better to have it let than continue to have the vacancy. Industrial portfolio, and again, this is very much in line with the other funds that have reported recently and the trends nationally, of industrial vacancies down to 2.7%. Total arrears are only 8.8 million, and the renewal success rate there is 74%, with renewal growth in rentals of just over 5%. So it still remains fairly tough in the industrial space. The market sentiment, specifically manufacturing and factory output data, remains cautious. The continued demand, the real demand that is out there, is for large warehousing and distribution facilities. The smaller units, midi units and light manufacturing is still marginal and showing the slowest recovery. The vacancies, I think, will be difficult to maintain at these levels, but we are looking for some real development opportunities in the industrial space. I think the other dynamic in industrial is not only have we seen the rental growth, but we're also seeing a tendency for longer lease terms, where we're now starting to see tenants happily signing longer than 3-year leases, which wasn't the case a year or so ago. And utilities management and the administered costs remain a particular challenge in the industrial space. V&A Waterfront, if you look at the mix of income that we received from the V&A Waterfront, we've got about just over 55% of the income, the net property income, coming from the retail portfolio, 24% from the office portfolio, 8% from the fishing and industrial properties, and 12% coming from the hotel properties. If you look at the retail, for the portfolio as a whole, the vacancy factor at the V&A is 2.1%. The arrears at the V&A is sitting at 30 million with a bad debt provision of 13.7. That is probably quite high if you benchmark that against Growthpoint and the balance of the Growthpoint portfolio. But that is also impacted again by significant rates back charges, which arose after the dispute between the V&A Waterfront and the City of Cape Town was resolved in late 2010, early 2011. The renewal success rate at the V&A running at 94.7%. So turnover growth at the V&A has been particularly strong, and it's always dangerous to just highlight the last couple of months, but in the last 5 months, since the onset, I think, of summer in about September, October last year, we've seen growth rates in turnover, in high double-digit growth rates in turnover at the V&A. Rental in the Victoria Wharf is in line with expectations. The clock tower and the redevelopment of the clock tower, and then the take-up of letting there, both in terms of the office and the industrial space, has probably been a little bit disappointing and has caused a slight shortfall on the budget. The vacancies in the Victoria Wharf are 1.3% and in the clock tower 3%. The arrears are inflated, as I mentioned, due to the rates back charges. And encouragingly, I think the renewals in what is, it's got many names, but we've called it the luxury wing here, It's also known as Death Row and it's got various other names. But the renewals there have in fact been, and the renewal risk there, where all the leases were coming up for renewal in March 2012, has totally been dealt with. And we have seen some negative reversions there, but the impact has been minimized, and the entire renewal process, if you want, has been de-risked. So most of the tenancies, we addressed the renewals early, and in fact deliberately let some of the tenants that weren't performing off their leases, whilst in other instances negotiating renewals with the tenants that we wanted to keep there. In the office sector at the V&A Waterfront, again, the rentals slightly behind budget because of the clock tower. The vacancies in the clock tower at the moment, they're 6%, reflecting the lower letting at the clock tower. 80% of that space is under offer at the moment, and we hope to get some positive news and feedback on that in the next short while. So if those vacancies are let, the vacancy level will drop to 4% in the office sector, which is closer to a normalized level. The hotel sector, I guess, across South Africa, hotels are under pressure. If you look at the results of all the companies that have got exposure to hotels, you'll know that hotels are still struggling. It's a bit of a carryover from the 2010 World Cup oversupply. And certainly within the V&A, we're also experiencing some of that. So the turnover rental, which we had originally forecast and budgeted to receive from the hotel sector, is not going to materialize to the level that we budgeted, probably about half of what we budgeted. And that is, again, as I said, due to the occupancy levels as well as the average revenue per room, where rates have come down. And the industrial portfolio and the marina revenue remains strong and marginally ahead of budget. Just to finish, I think, on the V&A Waterfront, a couple of comments. In all, the performance is very, very much in line with what we had originally budgeted and expected. We expect to receive cash distributions out of the V&A 100% in line with what we had projected when we did the due diligence and finalized the transaction. We also believe that, at the time that we did the transaction, there was concerns perhaps that the V&A Waterfront would be dilutive to Growthpoint and dilutive to Growthpoint's growth. But in retrospect, if we go back and look at our assumptions that we had made at the time around debt and debt funding and the cost of funding, as well as the issue of equity and the rate at which, or the price at which we would issue equity, it's certainly our belief that, we know for a fact that those have turned out better than we were originally projecting. So it would be our view that the V&A Waterfront, certainly on this set of results, has had no dilutive effect. If you look at Australia, you may remember a year and a half ago, Australia was 100% focused industrial fund. We have managed to grow that fund. We've invested over $800 million over the last 2 years in that business. The current mix is that the net property income is about a 70-30 split, 70% industrial and 30% office. And by value, you're looking at about a 60-40 split between industrial properties and office. So this is a bit small. I hope you can see it on the slide. We extracted this from the Growthpoint Properties Australia results presentation. They released their results on, I think it was Monday this week. So the statutory profit for Growthpoint Australia was up 8.2% to $26.9 million. And the distributable profit, 57.5% increase to $24.9 million, mainly driven by the acquisitions and the increase in the size of the portfolio. The distribution for the half year out of Australia is 8.7 cents, and that represents a 3.6% increase on the comparable period distribution for the half year 2011. The GOZ-N shares, which are the rights offer shares that were separately listed, received a 7.5 cent distribution, which is a direct pro rata to the 8.7 based on the time that those shares were in issue, or the timing of the receipt of the cash, if you want, by Growthpoint Australia. Growthpoint Australia returned 9.1% total return for the calendar year to 31 December 2011, and that's a dollar return. Capital management, we extended the average debt maturities in that business now to 4 years. It's been particularly tough going in Australia dealing with the banks, but I think we've done particularly well in the last 6 months to extend the facilities, which were always very short-term facilities, to an average debt period now of 4 years, debt term now of 4 years. We've also tranched the maturity. Prior to these recent deals, we had one facility of $660 million, which came up for expiry on one day, and that was the total of our debt. That was obviously way too risky. We've now tranched this, and we've got a third of the debt expiring in 2014, 15, and 16. The loan-to-value ratio just below 50, and the interest cover ratio 2.1 times, and 99% of our interest rate exposure there has been hedged. There are a number of critics who suggest that the loan-to-value ratio, certainly the Australian investors, at around 50% is too high. We currently believe that given the cost of debt relative to where our shares trading and the yield that our shares offering there, it makes absolutely no sense to de-gear. When your debt is costing you 7.7% roughly on average, and your shares are yielding 9% in Aussie dollars, it makes no sense to go and issue shares at 9% to settle debt at 7.7. So we're pretty happy. We think it's reasonably conservative given the nature of the portfolio, the interest cover ratio of 2.1 times, the interest rates fixed, and we've got weighted average lease length there of just short of 8 years. So on the company or comparative return on equity growth, we significantly expanded the market cap there. We currently have a market cap of around $740 million, as well as the free float in absolute dollar terms has increased substantially as well. We outperformed the A-REIT index as well as the broader market, and we had 2 rights offers that were taken up, underwritten by Growthpoint, where we raised $289 million into that Australian business. On the property side, 2.1% increase in the value of the portfolio. We have 100% occupancy in that portfolio and have had since our initial investment there in about April, May 2009. It's been 100% let all along. And we have 100% tenant retention there. I think those dynamics will change as we diversify into offices. The previous portfolio, whilst it was industrial, you had very big properties with very long leases, single tenant, triple net leases. Diversifying into offices, we have obviously brought on multi-tenanted offices in Brisbane, as well as one under construction in Sydney, and then also in Adelaide, and not quite offices in Melbourne yet. But the office portfolio, I think you'll definitely see the dynamic change where you naturally will see the odd vacancy pop up, and you will also see that not every single tenant renews its lease. We are very well diversified by location, as well as sector and tenant in Australia. The outlook, I think it's diversified portfolio, currently valued at, once we complete the 2 fund-through developments that we're busy with, will be $1.5 billion. We really have a good quality tenant base there with Woolworths and Coles, which is Australia's top 2 retailers as our tenants in the industrial portfolio, General Electric, and numerous other listed property companies being our tenants. We see the weighted average lease length there is 7.8 years. Again, just as a comparison, In South Africa, we renew in the order of 15 to 20% of our leases every year. And based on the size of the portfolio, that's almost 1 million square meters a year that we renew in a 12-month cycle here in South Africa. In Australia, we have 18% of our leases coming up that renew over the next 6 years. So we only have about 3% of our leases there to deal with per year for the next 6 years. The continuation of the business model, providing secure growing rentals from rent. Again, a big diversifier for us in Australia. We've emulated the South African model. 100% of the income is from rent, from contractual income. Very different to most of the other Australian listed property companies that have all sorts of other businesses other than pure rent collection or pure property ownership. They do funds management and development, and a lot of them have got residential exposure. So we do offer quite a unique investment opportunity in Australia. And then the guidance for the full year is confirmed at 17.5 cents. So we did 8.7 for the first half. We would expect then to do 8.8 for the second half. If we look at acquisitions, disposals, developments and commitments, relatively quiet period actually compared to previous years. Total value of the acquisitions was 1.8 billion, 1.7 of that taking place in Australia, and the balance of 140 million taking place here in South Africa in the office sector. Details, I think, are in the schedules at the back. We sold properties to the value of 459 million, 43 million of that in Australia, the balance 419 odd million here in South Africa. And in aggregate, the book or the profit on the historical cost plus capex was 129 million, whilst the profit on the book value, there wasn't really a profit on the book value. We sold it at aggregate at the book value. Now again, we get questioned on this is, how come, does that mean your properties are fairly valued all the time? I think as a mix of yes, the answer to that would be yes, but also that very often the sales drag on due to inefficiencies once again in terms of transferring properties, dealing with councils on rates clearances, the whole conveyancing process. More often than not, the sale in itself takes almost 6 months to conclude by the time you've got your cash in the bank. Now that would then span either a half year or a year end, and what we do is at the half year or the year end we would write that property up to the sales price. So by the time the thing actually happens and you see the result, it looks like you made no profit on book value, but the write-up happened through the fair value adjustment prior to the half-year or year-end results. We're still seeing pretty good profits on book value. Properties where we spent in excess of 20 million in the portfolio, a lot of that in the industrial space. You can see Grenville, 61 million, Greenbushes, 39, Growthpoint Industrial Estate, 29, OK in Pangeni, where we refurbished that centre, 28 million, and then the Adcock Ingram, 28 million. We see quite a lot of opportunity in our industrial portfolio. We have something like 2.3 million square metres of industrial space. We do have exposure to all the traditional as well as new industrial nodes. And if you look again through the details of the pack, you'll see that the average value per square metre of our industrial portfolio, including the buildings, is just over 3,000 Rand a square metre. And in many places we're seeing land being sold at 3,000 Rand a square metre, bulk square metre. So we think that there's a lot of opportunity to redevelop many of the properties in our industrial portfolio. On the commitment side, we have commitments for developments amounting to 761 million. A further 710 million is committed for acquisitions. That's here in South Africa. In the V&A, we've got our share of the Allan Gray development is 259 million. And in Growthpoint Australia, we have two buildings where we are constructing brand new 4 and 5 star Green Star rated office buildings, and the commitment there is 115 million Australian dollars in aggregate. All right, in closing, just some prospects. We do believe that the growth in distribution per linked unit for the full year will be in line with the growth rate that we achieved for the 6-month period to December. Growthpoint Australia and the VNA are now major contributors to the overall performance of Growthpoint, with between 25 and 30% of the total net property income expected to be contributed by these investments. R1 billion and 50 million actually was invested in GARS on the 25th of January 2012. Based on the expected returns there and the funding cost from South Africa, we expect that to be enhancing. The VNA is expected to deliver just over 7% return on cost on the development properties. Our share of the 50% of the cost was 4.25 billion for the developed properties, and that is in line with the due diligence forecast. Obviously, with the fact that we are now expensing the interest cost on the bulk, net bottom line yield will be lower than the 7%. The moderate forecast for GDP growth of between 2.5% and 3% is insufficient to stimulate strong demand for retail, office and industrial space. The overall vacancy factor is unlikely to reduce much below the current 4%, with negative rent reversions in the office sector unlikely to change until such time as national office vacancies across all grades start to improve. We're seeing that the A grade office space has performed well, but the B and C grade office space has not performed well. And we believe only until such time as you see a big turnaround in the B and C grade space will you really start to see strong rental growth back in the A grade space. Continued focus on tenant retention, debt collection and credit vetting, letting, cost management and development and redevelopment opportunities. We have a more focused and active treasury management through the appointment of a dedicated corporate treasurer. We've employed a lady who will be joining us on the 1st of March as a dedicated corporate treasurer, and we hope that her efforts as focused on treasury management would also yield some good results for us. Access to liquidity remains good, with strong demand for Growthpoint's corporate bonds and equity, as well as a willingness by all the major banks and life companies to provide debt facilities to Growthpoint. The biggest negative, I guess, for the right at the end, which is the significant increases in electricity and rates and taxes and other administered costs, as well as these costs being and the increases in them being well in excess of inflation, as well as our contractual annual rental increases of circa 8.5% to 9%. All of that coupled with deteriorating infrastructure and reduced service levels will have a major impact on our overall cost of occupation for our tenants, and remains, I think, for the industry, a major concern. So ladies and gents, I think that concludes the presentation.